Welcome back to Smart Traders, a home for every smart trader. My name is Risk Taker, and this is part 3 of our Deriv Trading Automation with Dsmart Traders. In part 1, we introduced Dsmart Traders and talked about the vision behind the journey. In part 2, we explored the Dsmart Traders environment and became familiar with the main areas of the platform, including the dashboard, bot builder, trading app, Smart Trader Pro, charts, analysis tools, reports, etc. And at the end of part 2, I told you that we are getting closer to the practical side of the automation. But before we open Bot Builder and begin constructing the strategies, there is something even more important that I need to establish. We need to speak the language of the trading, because when we eventually tell a bot what to do, that bot is going to work with the things such as ticks, prices, digits, duration, barriers, contract types, markets, entries, and the outcomes. So if those terms are not clear in your mind, Bot Builder will look complicated. But once you understand the language, many things inside the automation platform suddenly begin making sense. So today, we're going to build that foundation. And whether you are completely new to Deriv or you have already been trading for some time, I strongly recommend that you follow this lesson carefully, because some traders know how to place trades without actually understanding the terminology behind what they are doing, and we don't want that. Remember the principles of this series. We are not learning where to click, we are learning how to think. So let us begin with one of the most important concepts in trading automation: the tick. What is a tick? A tick represents an individual movement or update of the market price. Think about the market price being reported to us. Maybe the price is at 62.34.51. Then the other market update arrives. Maybe the new price becomes 62.34.53. That new market update is another tick. So another update arrives maybe at 62.34.49. Another tick, and this continues as the market changes. This is very important. A tick is not simply another name for 1 second. A tick is connected to the market price movement and the market updates. So time is something very different. Some instruments may generate ticks very frequently. Some Deriv synthetic indices have variants designed around 1 second tick intervals, while other instruments can operate differently. So whenever you hear someone saying that 1 tick always means 1 second, understand that this is not the best way to think about it. For automation, think of a tick as a new price of the market price information arriving. That is very important idea. And how can you understand why ticks are so important to bots? A human trader may look at the charts every new second, but a bot does not have to work like that. The bot can continuously receive the market updates and evaluate its condition every new information when it arrives. So for example, a new tick arrives, the bot reads that price. Another tick arrives, the bot reads that new price. Another arrives, the bot checks whether your condition become true. That is the beginning of event-driven automation. So now let us talk about a tick chart. When you view market movement as the individual ticks, you are looking at one of the most detailed view of how the price is changing. You will often see this represented with the line moving upward and downwards as new prices arrive. But remember, the line itself is not the tick. The tick is the market update. The chart is simply showing those updates visually. That distinction will become very important later when we work with Dsmart Traders. Now that we understand the ticks, let us talk about time. You will frequently hear traders talking about seconds, minutes, hours, days. These are the time measurements, and they should not be confused with ticks. For example, a strategy might say, analyze what happened during previous 5 ticks. That is the tick-based logic. Another strategy might say, analyze what happened during the previous 30 seconds. That is time-based logic. Another may use 1 minute information. Another may analyze 5 minutes candles. Another may use 1 hour candles. These strategies are not asking for the same question. This distinction becomes extremely powerful when we start automating, because a bot needs precise instruction. If your strategy says wait for 5 ticks, that means something different from wait 5 seconds, and both are different from wait for 1 candle. Automation forces us to become very precise. So now let us introduce another very important concept, candlesticks. A tick shows us an individual market price update. A candle summarizes that price activity over a selected period. For example, you might have 1 minute candle. During that 1 minute, many different ticks may arrive. Instead of showing every price update individually, the candle summarizes what happened during that minute. So a standard candle gives us 4 important values: the opening price, the highest price, the lowest price, and closing price. And you will often hear traders shorten this to open, high, low, close, or simply OHLC. So let us make that very simple. Open means the price where that candle began the journey. High means the highest price reached during that candle. Low means the lowest price reached. And close means the price where that candle finished. Suppose we have a 1 minute candle. The minute begins with the market at 100. During that minute, the market rises to 106, then it falls back to 98. And when the minute finishes, the price is at 103. Our candle will tell us that the open is 100, the high is 106, the low is 98, and the close is 103. So we have taken many individual price movements and summarized them into something that is easier to analyze. Now, imagine automation. A strategy could say, enter when the current candle closes above the previous candle, or enter when 3 consecutive candles close higher, or analyze the high of the previous 5-minute candle. Those are candle-based strategies. Another strategy may completely ignore the candle and work directly with ticks. Another might work mainly with digits. This is exactly why Dsmart Traders needs different tools. Different strategies look at different markets. Now let us move into something that is extremely important for many Deriv traders: digits. Every tick comes with a quoted market price, and that price has the last digit. Imagine market price is at 7,438.57. The last digit is 7. If the next tick becomes, for example, 7,438.62, that last digit is 2. Then perhaps price is at 7,438.68. Then the last digit is 8. So when we talk about digit movements, we are not saying that the entire price move only from 7 to 2 to 8. No, we are extracting the final digit from each incoming tick price and analyzing that digit. That distinction is extremely important. Tick movement examines the market price updates themselves. Digit analysis extracts the last digit from those ticks prices and analyzes that sequence. So from several incoming prices, our digit sequence might look, for example, like 7, 8, 9, 0, 1, 2, 3. And now automation can start asking questions about those digits. This brings us to the digit even and digit odd. The digits available are 0 through 9. The even digits are mainly 0, 2, 4, 6, and 8. And the odd digits are 1, 3, 5, 7, and 9. So in even or odd contract, the important thing is the last digit of the final relevant tick. If you select even, the outcomes depend on whether that final digit is even, and if you select odd, it depends on whether that final digit is odd. Simple. So, but now imagine what these Dsmart Traders can eventually allow us to do around that idea. Instead of blindly choosing even or odd, perhaps a trader wants to analyze a sequence of previous digits first. Maybe the trader wants a particular condition to occur. Maybe several conditions need to agree. Only after those conditions are satisfied should the automation consider an entry. That is where strategy logic begins. Next, we have matches and differs. Here, you select a particular digit. For example, you might select 5. With matches, you are predicting that the last digit of a relevant final tick will be 5. With differs, you are predicting that it will be anything except 5. So then we have over and under. Here again, a particular digit acts as your reference. Suppose your prediction is over 4. For the final digit to become over 4, it needs to be greater than 4. So it's like 5, 6, 7, or 9 would satisfy that condition. If you choose under 4, the final digit must be below 4. So it's 0, 1, 2, or 3 would satisfy it. Notice something important here. The prediction digit itself is normally not counted as over or under. 4 is not greater than 4, and 4 is not less than 4. These small details matter enormously when you begin writing the automated condition. A human being can sometimes work with value thinking. Software cannot. The condition is either true or false. This is one of the reasons we are spending time on terminologies before opening the bot builder. Now let us move away from digits and introduce another fundamental concept, the spot price. The spot price is essentially the current market price at a particular moment. When you enter a certain contract, you may hear terms such as entry spot and exit spot. The entry spot is relevant to market price when your contract begins, and the exit spot is relevant to market price when the contract finishes. This becomes easy to understand when we introduce the rise and fall, etc. With rise and fall, you are predicting whether the market price at the end of the contract will be above or below the entry price. Suppose the entry spot is 1000. If the contract finishes at 1005, the market has finished higher than where it entered. If it finishes at 995, it has finished lower. So rise and fall focuses on the relationship between the exit price and the entry price. Now let's compare that with the high and lower. Higher and lower introduces another important word, barrier. A barrier is the target price or level used by the contract. With higher or lower, you are predicting whether the final market price will finish above or below the barrier. That is different from simply comparing the final price with the entry price. This is why understanding the terminologies matters. Rise and fall, high and lower. They may sound similar, but the logic behind them is very different. Then we have touch and no touch. Here the question changes again. Instead of asking only where price finishes, the contract asks whether the market touches a particular barrier during the contract type. If the condition is touch, The important event is whether that level gets reached. With no touch, the question is whether the market avoids that barrier during the contract period. Notice how each trade types creates a different logic question. So rise or fall relatively to entry, higher or lower relative to a barrier, touch or avoid a barrier, even or odd last digit, match or differ from a digit, over or under a digit. And when we eventually enter bot builder, these concepts become conditions that software can understand. Now let us introduce another fundamental term: duration. Duration means how long the contract runs. Depending on the product and the instrument, duration may be expressed using ticks or time. You may encounter duration involving ticks. You may encounter seconds, minutes, hours, and depending on the contract, longer periods. This is another reason not to confuse ticks with seconds. If the system asks you for a duration of 5 ticks, give it 5 ticks. If it asks for a duration for 30 seconds, then that is the time duration. If it asks for 5 minutes, that is another time duration. Both need exactly definition. Next is stake. Stake is an amount you commit to trade. Then we have payout. For digital options, when the contract conditions are satisfied, the contract pays according to the quoted terms. Before entering a trade, understand the amount you are risking and possible outcomes. Never allow automation to make you forget that real capital is involved. A bot does not feel fear. A bot does not understand that you need the money tomorrow. If only you understand, it only follows your instructions. That makes your risk rules even more important when automation is involved. Now let us zoom out and talk about markets. When you open Deriv, you may encounter several different categories of markets. There are traditional financial markets such as forex, stocks indices, stocks, commodities, cryptocurrencies, and depending on the platform, ETFs and other instruments. The Deriv also provides what it calls derived indices, and this is a very important area for many automation traders. Derived indices are Deriv created markets with different characteristics. One important category is synthetic indices. Synthetic indices are simulated markets designed to operate independently with real-world news and traditional market hours. Many synthetic indices are available around the clock, including weekends. Within that world, you may encounter names such as volatility indices, crash and boom indices, jump indices, step indices, and other types. Do not worry about memorizing every index today. That would defeat the purpose of this lesson. The important thing is understanding the hierarchy. A market is the underlying instrument. Your strategy is the analyzing and trading. Yeah, I think you get that. Your strategy is analyzing and trading. Different markets behave differently. Different contract types may be available on different markets, and not every trade type is necessarily available for every instrument, account, or platform. This matters enormously for the automation. Before the bot can ask, should I buy, rise, it needs to know which market we are analyzing, which contracts are available for that market, what duration is allowed, what parameters does this trade require. These are the questions behind the buttons you'll eventually see inside Dsmart Traders. Now let us clarify another piece of terminology. You'll hear me use the phrase trade type, and you may also hear contract type. In our practical tutorial, these ideas are closely connected, and a contract defines specific prediction and the condition you are trading. For example, rise or fall, even or odd, match or differs. over or under, higher or lower, touch or no touch. Deriv currently groups several products under this its options offering. Digital options are very important family. There are also products such as accumulators options, vanillas options, turbo options, and multipliers. We do not need to master all of them today. Our purpose today is build a map inside your mind. When you hear those word market, think, what am I trading? When you hear a tick, think a market price update. When you hear digit, think the last digit extracted from a tick price. When you hear candle, think a summary of a market activity during selected period. When you hear duration, think how long the contract runs. When you hear entry spot, think the relevant price when contract starts. When you hear exit spot, think the relevant price when contract ends. When you hear barrier, think a target level used as a part of a contract condition. When you hear stake, think the amount being committed to that trade. When you hear contract type, think what exactly am I predicting. That mental map will save you tremendous amount of confusion later. Now let us connect everything we have learned today directly back to Dsmart Traders. This is where the lesson becomes important for our automation journey. Imagine that we want Dsmart Traders to automate a strategy. The software needs information. Which market? Maybe a volatility index? What information are we analyzing? Ticks? Digits? Candles? What time frame? Tick by tick? 1 minute? 5 minutes? What trade type? Rise and fall? Even and odd? Over and under? What is the condition? Maybe something needs to happen in the previous tick. Maybe our previous digits need to satisfy a rule. Maybe candle needs to close in a particular direction. What happens when the condition becomes true? Enter a trade. How much should I stake? How long should the trade run? And after the trade finishes, what happens next? Do we stop? Do we wait? Do we analyze again? Do we change the stake? Do we apply another risk management rule? Now, you can begin seeing what a trading bot actually is. It's not a magic. At its core, automation is a structured decision making, receiving information, analyzing information, checking condition, making a decision, execute an allowed action, manage the outcome, repeat according to the strategy. That is why I keep telling you the goal is not to blind automation. The goal is to intelligent automation. A badly designed strategy does not become a good simply because a computer executes it. Automation gives the speed and consistency in your instruction. That means the quality of your instruction matters a lot. And before you can give good instruction, you need to understand the language of the market. That is exactly what we have established today. Now, when we open Bot Builder, words such as markets, tick, candle, digits, duration, barriers, tick, entry, and contract type should no longer feel completely foreign. You should begin seeing them as pieces of one system, and that system is what we are going to start assembling. Before we finish, one more important reminder: trading involves risk. Understanding terminology does not guarantee that a strategy will be profitable. Finding a pattern does not guarantee that pattern will continue, and automation does not remove uncertainty from the market. Always practice responsibly. Test your ideas, use demo environments when learning, understand what the strategy is doing before allowing it to the real funds, and never risk money that you cannot afford to lose. Today was about building the language. In part 1, we understand the vision. In part 2, we understood the environment. Today, in part 3, we have started understanding the market information and terminology. That is our automation, how it will work. And now the pieces are becoming together, because in part 4, we can finally begin moving into the bot builder with as much a stronger foundation. Instead of opening it and asking what does all this means, you'll begin to open it and saying, I understand what market means, I understand what a tick is, I understand digits, I understand candles, I understand duration, I understand what a contract type is. Now show me how to turn those ideas into automation. And that is exactly where we are going next. If this lesson helped you understand something that was previously confusing, leave a comment and tell me which concept became clear for you. And if there is some if there is a trading term you still do not understand, put in the comments as well. We are building this series so that every smart trader can move forward with understanding and not confusion. Subscribe and follow the complete Deriv Trading Automation with Dsmart Traders series so you do not miss part 4. This is Dsmart Traders, a home for every smart trader. Learn the language, understand the logic, then automate it intelligently. I'll see you in part 4. Bye.